Well, good morning, everyone. It's Monday, it's April 6th, and what do I always say? Let's get into it right now. All right, so today's topic is week ahead. What are we expecting the week ahead? Obviously, as we all know, coronavirus is dictating the progress and the fluctuations in the stock market and volatility. Everything else is still taking back seat, but it's important to know the numbers to see what we can expect and to see how far we can go. The big reports for this week is going to be the FOMC minutes. That's going to tell us what the Feds were talking about when they were deciding what to do in terms of raising rates or not a few weeks ago. And the truth to be told, we pretty much know what they're going to be talking about. It's not going to be any major shocks in light of what we've been seeing with the coronavirus. Another major report is the petroleum status report. It's going to tell us if the demand or supply is going higher or lower. That's going to be really, really important because we've been having so much supply of crude oil. It's been keeping prices really low. Now, Thursday, we've got jobless claims, we've got the PPI, and we got consumer sentiment. It's going to be really interesting to see what the consumer sentiment is because this consumer sentiment on the 9th is going to take into account the majority of the coronavirus anticipation, panic, fears, prospects, and so forth. So it's going to be really important to see what consumers are thinking because remember, consumers make up about 75% of the GDP, and the GDP is what the Fed uses to figure out or discuss whether to lower rates or to jack up or increase interest rates. That's going to be really, really big. And then Friday, we have the CPI report. But again, I think the biggest reports are going to be the FOMC. I think that's going to be a good validator. The petroleum report is going to be huge because we need to know if the supply is getting smaller or larger. Jobless claims, and most important, which is not usually that important, but this week it's going to be big consumer sentiment. I'm really, really focused because I want to see what consumers are thinking. The consensus prior was 89.1. Consensus is 75. And as you can see here, we're all over the place. All right. We are literally all over the place. Anywhere. It's kind of like anyone's guess goes. But it's going to be really important because the University of Michigan questions 600 households each month. So this report is going to give us a good indication of where we stand. And this coronavirus has been with us now for over a month, really heating up in the U.S. for over a month, or right about a month. So this should give us a good indication of where we stand. And again, keep your eye out for the Wednesday's FOMC report, which actually happens 2 hours before the market closes, the jobless claims, the petroleum report, and consumer sentiment. Those are going to be the biggest reports. Now, as far as news. Stock markets rose overnight from Sunday to Monday. We've been getting less impact from the coronavirus. Less people are getting sick than was anticipated. Benchmarks were up about 3% in Paris, Frankfurt, and Tokyo, jumped more than 4%, which is very positive. Oil prices, on the other hand, which are really causing the stock market to really sag as well. It's putting a lot of pressure because there's a lot of energy companies in the S&P 500 and the Dow Jones. Oil prices fell back after reports said a meeting between OPEC and Russia reportedly has been delayed until April 9th. Now, April 9th is the day after this petroleum report comes out, so it's going to be telling. Numbers of people dying appears to be slowing in New York, Spain, and Italy, which is why the market overnight is up today. This is better than expected. Those numbers that we got about a week ago from President Trump, 100,000 to 240,000 deaths, they seem a little bit high, and hopefully we can get those numbers down. Japan was preparing to ramp up its precautions because things are not looking good there. They're actually getting worse. Shanghai was closed for public holidays. Analysts say that only a peak in the number of new coronavirus will bring some clarity into how deep and protracted the economic downturn will be. This is what I've been saying all along. We're not going to know how bad things are till after the peak, and right now it's a moving target. As of right now, it seems like the numbers are flattening, are slightly getting better, which is very, very promising. And if we can keep the rate going lower, it's going to increase the economic upside. The United States has more than 377 confirmed cases, leading the worldwide tally more than 1.27 million, according to Johns Hopkins, and they know what they're talking about. More than 69,000 people have died, but over 260,000 have recovered, which is very, very positive. Again, U.S. companies poised to start COVID-19 vaccine tests, safety tests. That's very positive. And Japan tried doing what England tried to do, kind of exposing everyone to it and seeing if we can get the antibodies in. But too many people have started dying, and they decided to take emergency action, which is very, very smart. They're going to ramp up their precautions. Let's now look at the stock market to see what we're expecting for the week ahead. Now, you see this box here? This box actually takes a pretty good account of what price action should be over the next few days. This is the SPY. This is the ETF that tracks the S&P 500. So if you look at the SPY, the resistance level is right around the 264 level, which on the SPY, on the E-mini S&P, you have the SPY, you have the S&P 500, and you have the E-mini futures, and they're all saying the same thing. It's just fractions and decimals. So the SPY is at 264, the S&P 500 is at 2640. Doesn't matter which one you look at, they follow each other tick by tick. We have strong resistance at the 264 level, and we have really strong support at the 219 level. There's a good chance we're going to stay within this box, within this trading range this week or for the foreseeable future. If you look at the Dow Jones, I know a lot of you are looking at the Dow. Let's just go through this on the Dow, which closed down 360 points on Friday. But let's take a better view of the Dow so you could see what I'm expecting. I'm expecting the highs to be no higher. I don't think we're going to go higher than 23,000, 23,100. And I don't think we're going to go lower than 19,000. So I think the trading range will be between 23,000 and 19,000, which is a quite wide range, but the volatility's been all over the place. It's been going a little lower here for these last 3 days. So if you want short-term resistance, it's at 21,500. and 20,700. If we break above 21,500, we're going to open at about, let's see here. Let's see where we're going to open. Let's look at the futures here. The Dows are going to open up at about 797 points higher. So we're already going to open up above. This is why I love looking at overnight data. Let's see here, 21,000. So this right here, 22,740. This is the futures. This is the Dow futures. I would say that's the overnight high. 21,750. I would say 22,700 would be a good safety zone for the upside. And the downside, again, 19,000, 19,500, 20,000. So say 20,000 on the bottom and about 23,000 on the upside. Just as what I was anticipating with the DIA, which is the diamond. So around here, around 2,227 on the diamond, and right around 19,500. So about 22,000, 23,000, and about 19,500 to the downside on the Dow Jones. Now, if you look at the S&P 500, our momentum levels, we're now finally starting to turn. And if you could see here, this is 2008. We sat around here for about 4 months, 3.5, 4 months. There's a good chance this will, the momentum levels, right now there's only 8 stocks in the S&P 500 that are trading above the 200-day moving average. Can you believe that? We went from like 410 stocks to like 10 stocks trading above the 200-day moving average in about a month. Crazy, right? I told you it was going to happen right here. Anyhow, the bottom line is I think we're going to kind of hover around here just like we did around 2008, and we're going to measure to see whether the number of cases is increasing or flattening. And I think that's going to happen over the next few weeks. I think that the stock market could potentially go down quite a bit, not quite a bit more, but maybe another 5%. But here's what I'm finding interesting. Volatility level, this is the VIX. We peaked out at about 82 when the market bottomed at about, let's see here, the market bottomed at 181 on the Dow Jones, 18,000 on the Dow Jones. But notice, we've been going up and we've been going down. The last 4 days, we went from about 22,000 to about 20,000 on the Dow, but volatility has been going down. That's very positive, and that's telling us that panic fear, just that emotional fear that everybody running out of, the city and looking for cover, that's done. We're done with that. There's a good chance volatility will go higher till about 70, 65, 70, but I think we're done with the peak. So most probable, what are we expecting this week? We're expecting to see if the curve flattens out. We're expecting to see if the expectations of the death toll is going to slow down versus what we're expecting. That's the main factor this week. All of this economic data, it's really, really important. But what's driving this market right now, what's driving the Dow and the S&P is the number of deaths versus the expectations. And if we can get those expectations below the actual numbers, then the market is going to rally. And that's going to be very, very positive. But again, volatility looks like it's about to pick up a little bit. The Dow Jones looks like it's going to be choppy with a lot of trading range. And we still have a lot of negative news. China's just now declaring emergency. This coronavirus, COVID-19, is just hitting South America and Mexico. So there's still a lot of stuff that hasn't been priced in. But what we can expect is more congestion, and expect the DIA, the diamond, which tracks the Dow Jones, to be between 22, 23,000 and about 19,000 over the next few sessions. And if you trade the S&P, let me give you those factors on the S&P. This way we covered the diamond, we covered the SPY. Let's now cover the S&P 500 index. We did the futures. I want you to have these levels on every asset possible. So this is the actual SPX index. So we're looking for a resistance of about 26,000, as I mentioned, and support at around 23,000, 2,300, sorry, 2650 to about 2317. Now you have the good resistance and support levels for pretty much every index. But again, the key this week is not going to be the reports. The key this week is going to be the number of deaths versus the expectations and whether that equity curve flattens. Now, folks, beginners, retail traders, they make a lot of mistakes. I mean, when I was showing you this, let me show you this, for example. This is a site that everyone should focus on. Let me show you this real quick here, just to give you a little example of this. Momentum levels. I want to show you this. I want to show you how inaccurate beginners and retail traders can be. Again, this is the S&P 500. Look at the line chart over 10 years. You see this right here? Everybody was a buyer. Over 80% of stocks were trading above the S&P 500 200-day moving average, and the market was really bullish, and I was telling everyone to start liquidating. If you don't believe me, look at my videos going back. Why? Because retail traders have a habit of making mistakes and doing the opposite of what they should be doing, and that's the key here. You can use that to make money. Folks, there is a reason. There's a reason why most new traders fail. They do the opposite. They're programmed to lose. Just like everybody, all the retail traders were buying here, and I was saying run the other way. Nobody was listening to me. And then the market crashed. Retail traders have an uncanny ability to pick the opposite side of what the market's going to do. The truth is, the majority of popular trading strategies that most beginners and novice traders use, they just simply don't work. They were never designed for stocks. They were designed for futures and commodities 30 to 40 years before traders began swing trading on stocks. I'm not kidding. ADX, RSI, moving averages, stochastics, all of those were invented for the futures and the currency markets 30, 40 years ago. So Wall Street even has a term for those that use these strategies. It's called dumb money. And they actively profit from betting against those traders. I'm going to tell you right now, professionals were not buying around here. They were selling to retail traders. That's what we were doing. We were telling people to get out of the market, but nobody was listening because traders were following historically old indicators that just don't work. I'm telling you, there's a better way. Now, there's a better way, and it's fairly predictable, which is how Josh Martinez and I were able to turn the tables on big institutional traders by doing the opposite of what retail traders are doing. There are indicators that you need to fade, and there are indicators that pro traders use that you need to follow. And there's a big difference between the two. And it's not a coincidence, and it's not random. There's an art to this, and there's a science to this. So we're taking advantage of these moves. We're taking advantage of fading what the retail trader does. We're fading dumb money, and we're taking advantage of smart money. And we're using a relatively unknown indicator we call smart money spikes. Folks, this indicator is awesome. And again, the truth is, majority of popular trading strategies that novice traders use or latch onto don't work. That's why most beginners lose money. They're relying on indicators and tactics that simply don't work. How about you reverse that on its head? So instead of having 7 losers, you have 7 winners. Instead of having 8 losers, you have 8 winners. Take these dumb money indicators, reverse them, and trade a little known indicator called smart money spikes. Click the link below or the button that appears on the screen. Get all the details. Folks, you don't want to miss this. Again, 95% of all the technical indicators that you're using to gauge short-term price action with stocks were never designed, traded, or tested on the stock market. They were designed for the futures and for the currency markets, but all of a sudden traders think they work. They don't. It's shocking, I know, but I'm going to tell you all about it. Josh is going to expose you to why and how. You don't want to miss this. You really don't want to miss this. Folks, I was using this simple indicator that you're looking at right now to tell everyone who would listen to me that this market was going to crash. And I didn't say it a day before it happened. I was saying it a month before it happened. How, why, how are you going to fade these indicators? How are you going to follow these indicators? You don't want to miss this. What Josh and I have to tell you is going to knock your socks off. I'm not kidding you. You're going to learn how to fade dumb money and trade with smart money. Follow the link below or click the button below and learn all about it now. Don't delay. Do it now. This is your opportunity to make a lot of money. The volatility's there. You just need the right technique. Learn how to do it now. There's nobody better to teach you than Josh and I. Talk soon. Have a great day.